All right, it is, welcome guys, it's 7:02. I'm gonna call the meeting to order. Welcome to the March 24th JRIB meeting tonight. Chris, do I need to announce who's here?
I think I have everybody. I have Carolyn, I have Jared, I have Chris Brand, Tom McCarthy, I have Nick, Kevin, and Jack Mahoney. Oh, and I have Scott. Scott's here too.
Yep.
I got you, Scott. 4, 5, 6, 7, 8. We have 8. Brenda's supposed to be calling in, and Eric Newman's going to be later.
But we've got the quorum, so let's go. All right, guys, let's go. So first order of business here is to hear, consider, and approve the minutes from the February 24th, 2021 meeting that came in the original packet that Chris emailed out. If I could ask everyone to, if you haven't yet reviewed it, take a moment, and if someone could make a motion, please.
My only comment, Carolyn, is there's a date wrong in that second paragraph there. 2102.
2102. We're not living in the future. Good catch.
Ah, okay.
And while you're changing that, Eric's name is misspelled in that same paragraph.
Yep, it's E-R-I-K.
Okay.
Any other changes, guys?
I'll make a motion to accept.
Okay. May I have a second, please?
I'll second.
Okay. Scott, I think you were still muted. Chris Brand seconded. All right. All in motion of the minutes with the adjustments of correcting the date and correcting Eric Caliper's spelling of his name. Say aye. Aye.
Aye.
Aye.
Okay. Any opposed? None. Abstain? None. Okay. Motion passes. All right. Guys, tonight is a super exciting night. We're going to hear the OPEB actuary evaluation. I'm delighted that Stefan from Hooker and Holcomb could join us tonight. I know we were disappointed not to see him last month, but good things come to those who wait. And so here it is. So without further ado, Stefan, if you could please take it away and feel free to share your screen.
All right. Let's see. Let's see. Share. I think it's. Make sure I pulled up the right one. Okay.
We can see it.
Okay. Let me just make it bigger. All right. So hope everybody's doing well. Yeah, we unfortunately was not able to present last month due to we just didn't have all the information that we needed. And actually, we didn't even get the final bit of information until middle of last week. So that's why there was a delay. And that's not quite uncommon in OPEB valuation, just because a lot of times the town people that are dealing with the administration of it don't always fully understand what we're looking for. So there's always some back and forth in getting the right piece of information. But without that, we'll step right into it. You know, I don't want to take up too much of your time, or only as much as needed. So we're going to review the 7/1/20 actual valuations for the basically the 2 plans that are funded, and we'll just briefly touch on the one that's unfunded. So what do we have on our agenda? We're going to talk a little bit about the purpose. It's very similar to the pension side. We'll review the results. I'll just show up a quick slide of our survey that we do every year when we look at the CAPRs for all the plans in Connecticut. And, you know, that just shows you how many plans are funded and how many are not. We'll talk about the funded status of this plan. We'll go into the development of the ADEC, which is really the meat and potatoes, everything. There's not a lot, but really the main thing that everybody wants to know about is what the ADEC is. and it's for the next 2 years. The projected benefit payments, those are the benefit payments that you expect each year. We'll just quickly show that, the data. Mention the investment return assumption and how we get that. And then any questions for going forward. All right. Okay, very similar to the pension plan, you know, the OPEB valuation does the same kind of thing. You're going to pay for benefits that are promised to participants. And what's that? The cost of the plan is typically benefits you're going to pay out. In this case, that tends to be premiums, medical premiums, because you guys are providing medical coverage for these retirees, as opposed to a monthly stipend. You know, you're going to pay the premiums each month, and those vary quite differently than on a pension side. You'll have expenses again. You hope to offset that totally by investment return, but that's not always the case. And in some plans, they do have member contributions as an active employee. So those kind of diminish each year's normal cost, the annual ongoing costs. So I mentioned in the past that there's an actual cost method that assigns the cost to how does, you know, for each budget year, what that is. And similar to the pension side, we use the entry age normal because that is what's required in the GASB. It just makes a lot of sense to do it that way. There's two components that make up the ADEC. Again, there's the ongoing cost, the annual normal cost, which is really the assignment of benefits that are earned each year. And then there's that old unfunded accrued liability that has to get amortized. That's the piece of the past service cost that is not fully funded. And that is very common in OPEB plans because most towns didn't start funding them until, you know, the last 4 or 5 years, you know, maybe some over 10 years, but it's very in the infant stages of that, of the funding of an OPEB type plan. And that amortization is 21 years, very similar to the pension side, and that's for both plans. Okay, any questions so far? Nope, okay. I don't know, did everybody get this presentation by chance? I don't know if that you all have it or not.
Yes.
I did, the secretary. Can
Okay.
you send that
Okay.
to me now, Stefan?
I sent it to Carolyn and Jared. So I don't know if, you know, I don't have everybody's email address, so I can't send it out, but.
I sent it around. I sent it around this evening. Chris, I sent it to you earlier in the day, but I think you were offline. So I sent it around to the full JRIP maybe
I left
2 hours ago.
30, so
Yeah.
I'm sure
I
I
just
have.
wanted to double check because we can certainly get it to anybody that doesn't have it. So moving on. So quick summary of the results and overview. The liability, how it's split between the two plans. Again, I don't show the Board of Ed here on this kind of page just because the Board of Ed is an unfunded plan and then we don't develop an ADEC for them. But for the police and fire in the town, the liability split almost 50-50, 56% police and fire in town, 44%. And that's not uncommon. I'd almost expect to see the police and fire get bigger over time just because those benefits tend to be richer. And that the whole point of that is because they retire at a much earlier age. You know, they don't retire at 65. They're going out, you know, anywhere from 50 on, 55 on. So that means their benefits are paid for a lot longer period of time. And those benefits pre-65 are really very expensive. Okay. So overall, in regards to premiums, the plan did very well. You know, they did some gains, which means that, you know, our assumption for trend was 7% back in 18, dropping 6.5% for 19, and that would have been 7%. But over those 2 periods of years, you had a gain on the premiums. They didn't quite go up that much. So you got a gain on both plans in aggregate, just under 4% at 3.9. The police and fire realized gains a little bit larger than the town of 5.8. The town had gains of 1.1, and this is only due to premiums. The difference really that you see on the town side is because they're actives, they retire a lot later, so you don't have as big of a savings there when the premiums go down because they're closer to 65 when rates drop due to Medicare. So that's the primary reason the difference there. And you'll see a lot of those differences between the two plans because there are a different makeup, you know, different benefits for each group. Okay. So then on liability side, due to data changes, you know, that would be people retiring earlier or later or whatnot, or dropping coverage, terminating. So that means another way of dropping coverage. That gave a loss of 5.2% on the accrued liability. Police and fire plan, that loss was 6.9%. And on the town, it was 3.1%. Again, the 6.9, well, it's bigger on the police and fire than because those who retire earlier, they just retire earlier. So it's going to be, you're going to have a larger expense earlier on. Okay. similar, there was definitely some assumption changes similar to on the pension side here. This valuation recognized when we changed mortality, because if you recall, we changed that in 19. So our last valuation was in 2018. So that change just gets reflected in this valuation. We also dropped inflation, very similar to what we did on the pension side. Other costs that are unique to an OPEB plan are the healthcare cost trend. And that's, again, how we expect the medical benefits to increase each year. And then we also we revamped the spousal election coverage. What that is when someone retires, what percentage of people will cover their spouses? And a lot of times that's dictated by the cost to a spouse. If it's free, we're going to see an election going to be almost 100%. When the spouses have to pay 50 to 100% of the cost, then that election drops a lot. Another key thing that happened since the last valuation was they finally repealed the Cadillac tax. What they had been doing was pushing it off each year. And then in 19, they finally decided to repeal that. And what that was kind of a penalty for a rich plan. As you can see, there's a bigger impact for the police and fire of 2.4%. The liabilities went down, whereas the town only went down by 0.7%. Again, that's because police and fire retire early, so they're going to hit that ceiling where the Cadillac tax will kick in. But again, that's no longer down, so that's a good thing for the plans. That's a savings. And the last bullet point on this page is just to mention that about 45% of plans in Connecticut are funded. That really hasn't changed too much in the last couple of years, but just to kind of, you're in that 50% group roughly. So some do, some don't, and there's many reasons for that. If retirees pay 100% of the cost, those plans tend to not be funded because it's really only an implicit rate cost for those plans. All right. Any questions on that? Anything there? Okay, moving on. This is the survey I mentioned that we do. We look at all the plans, we gather all the CAFRs for all the Connecticut municipalities that put them out there. And we kind of gather different data points similar to what we do for the pension side. On the pension side, we look at the discount rate, the funded percentage, whatnot, some of the assumptions. Here, this is looking again at how many plans are funded, what the funded ratio is. And you can see there's plenty of them that are unfunded plans, over 55% of them, as I mentioned. But even the ones that are funded, very few are funded more than 30, 40%, right? Have very few outliers, a couple that are 100% funded, some 80, 90%. Those are probably smaller plans that it was easier to catch up to fund those plans. So you guys are right in that, this 12% bucket here, the 20 to 40%, I believe. Okay.
Hey, Stefan, are you finding overall that towns are looking to allocate and kind of bolster their investment into the OPEB trusts, or are they holding at that funded ratio? Kind of as
this year, it's very similar to what happens with your plan. Everybody's kind of in the same boat where they had that big drop in asset values in the first quarter of 20. Started to see the rebound up, for the last 3 months of that fiscal year ending June 30, 20. So most of them stayed relatively the same, maybe inched up a couple percent due to, favorable experience. Some of the, that premiums, not everybody got favorable premium experience. We have some that on the flip side, their premiums went up. So, a lot of different, there's not really a normal, so to speak, when you look at OPEB plans, because they're very different. Each and every one of them is different. Think about how many unions you have in the town. Each union kind of negotiates benefits a little differently. Whereas pension, they tend to be very similar for most of the unions in the pension plan. They might be a little bit differently, but there's a lot more variety in there. Just even like the medical benefits that are offered, the premiums, the different type of health plans that they're offered. So most of them stayed relatively the same, maybe inched up a couple percent. So not unsimilar to what happened with your plans.
Okay.
All right. So just kind of briefly touched on those assumption changes that happened. The discount rate, we kept that at 7%, kind of similar to the pension plan. Although it won't be uncommon for OPEB plans to have different rates just because they may be invested differently, the way you look at the population and how long those benefits are going to be paid out. As I mentioned, as the town is a closed plan on the pension side, over time, you're going to probably move more of your income, more of your assets into a fixed income type of thing. So there'll be less exposure, and that will push the interest rate down. Whereas an OPEB plan, that's going to be longer. This is an open plan. All the new because you not only do you cover people in the pension plan, but you're going to cover the people in the 401A plan as well, because if they're getting benefits, so you're going to still cover the full population of the town. So, for instance, Jared wouldn't be in the pension plan, but he would be in this OPEB plan. Not this year, because he got hired after 671, I believe. Or maybe he is. I can't remember actually, but I did know some of the people that weren't in there or were in there that are new hires. So we kept that the same. One thing to note, like if you're talking an unfunded plan on the Board of Ed side, that discount rate is dictated by the 20-year municipal bond rating for police plans. That rating at 6/30 was 2.21%, and that's what we do in the GASB reports. Whereas that dropped from 3.51 the year prior. But again, that's an unfunded plan. That's really just a liability number that gets thrown in the CAFR. Mortality, I mentioned that. We adopted the pub mortality tables, similar to the pension side. As I mentioned back then, when we changed those, this was really the first study ever done by the SOA that was specific to public sector plans. And we did see a big uptick. One of the questions I have been getting a lot of the meetings was, what's going to happen with COVID? How is that going to affect mortality? And as I mentioned, I don't know if I mentioned this group or other groups, it's still a couple of years out before you know the full effects. And even as you hear that people, even though they've had COVID, they're still, 6 months down the road, they're still having the effects, that it's how it's affecting them and just how they can handle day-to-day operations. So we don't know what it's going to do to mortality yet. What I see happening is that it's going to pull the mortality table down. We're not going to expect to be living as long. So that would, over time, eventually, if it gets reflected, will probably be positive and drop the liability a little bit. The one thing that we did see was that when we adopted the new improvement scale, that dropped liabilities by about 0.5%, and that's been occurring every year, whether we stay with the pub tables or the old tables. That improvement scale still gets used every year, and that's, like I said, that's been dipping down every year since. Inflation we changed, as we did in pension, so that's kind of a mirrored. So both mortality and inflation, and say retirement rates, withdrawal rates, those would all be mirrored the same way in pension as well as OPEB. The ones that won't be is the healthcare cost trend rates. As I mentioned, when we did the 18 valuation, we used 7% grading down to 4.6%, grading down by 0.5% each year. We updated that to be 6.25, starting at 7/120, grading down to 4.4% by a quarter, or by 25 basis points each year. So that kind of gives you some reduction in cost. OPEB, like I mentioned, we looked at the spousal coverage, and based on the data that we have, we've been seeing that there's been a drop in the spousal coverage. So we lowered our assumption from 85% for all the town employees to, based on some groups were at 80%, others were down to 60%. I believe Public Works, maybe the THEA group, we were seeing less people cover their spouses. So that was a big savings on the town side. Police and fire, our assumption had been 60%, and that continues to hold true. You still see about 60% of police and fire covering their spouses.
Do you find that changes a lot year to year?
Not so much, but it's definitely something to be monitored because it could be costly. And again, what happens when contracts get up, and so now there are several contracts that are up and that haven't been settled yet. What happens is, as towns look to get costs, they may reflect additional cost sharing on the retiree side as well as the actives, or they may have, spousal coverage, which tend to be one of the ones that change a lot. Maybe years ago, 2 or 3 contracts ago may have been 100% spouse coverage, but they've been slowly whittling that away. Now, it may be 50% where the spouses pay. And so as the spouse have to pay more, and you'll probably see this in, if you cover your spouse in any work plan, that you may drop them, they may keep their own coverages. As you see more and more plans want to have where that worker is employed do the coverage, right? So you see the same thing here. So as the spousal cost goes up, you may see that coverage drop. So we continue to monitor that, right? Because that change is big. Even like the OPEB utilization rate, what that means is when someone retires, will they elect to have coverage to the town? Now, your town, that we assume 100% because the bulk of everybody is being paid 100% by the town. So who is not going to elect free coverage? I mean, I'm certainly going to want that. So you're going to find just about everybody and their mother is going to take that coverage. And if it was free for the spouses, you'd see that rate up a lot higher than it is now. Okay. So the impact of those changes was the liability for police and fire increased by 2.7%. And that's, again, mostly due to trend. Where at the town, their liability decreased. And really what happened is because that little tweak in the spousal coverage more than offset the change in trend. So that's why we really want to monitor that. And we want to make sure we get the best data. So we often talk to HR and what they're seeing as well. Because they know best, really, because they're the ones that deal with every day with the participants, and they know what their coverage is, and they see more of the trends because they're seeing those numbers every day. So we definitely talk to them quite a bit when we look at those assumptions. Okay. Now we'll start to get into next two slides are really the meat and potatoes of everything. This is a snapshot of the liability for each group and in aggregate. Couple of things to point out. We look at we'll look at the third column, this 90 million number. That's the total liability of retirees. So it's 145 to total liability. 90 millions of retirees, 55 is active. So that's about 60-40 split. That just shows you it's more expensive for the retirees. And you see there's definitely a difference by the different buckets. What we look at it as the retiree as well as the dependent, and whether they're pre-65 or post-65, right? So, and police and fire, what you always see is under 65, that liability tends to be, here on the retirees, it's 4 times as high. And why is that? Because police and fire can retire at a much earlier age than they do on the town side. So that tends to drive the cost for those groups. As over 65, the costs are pretty similar, because at that point in time, everybody's over 65. They're paying the Medicare rates. So you see that the same. And you'll see the same thing in the active side. One thing to point out, so both plans are roughly about $25, $26 million in assets. It's been the same way. What I could, you see the towns funded almost 42%, where the police and fire are only 32%. Again, what that's going to be due to the differences of benefits. Their ADECs are roughly very similar. They've been funded very similar over the last infancy of this. That may change going forward, but if you kind of continue to fund the way that is, I can almost see the town funded percentage improving quicker than the police and fire, just because the benefits are so different, or when they can elect them is different. Overall, you're at 36%, so that's, you're right on target where you want to be. Obviously, you like to be 45, 50. You're getting there, and you're getting closer to the point where you're going to start probably paying benefits out of the plan. All right. So here's the development of the ADEC. Again, the top bucket is the town's normal costs. You can see it's offset a little bit by employee contributions. Difference here is most of the town groups don't pay any contributions as an active employee. You had a distinction here. There's active cost sharing, and there's active employee contributions. So employee contributions would be like funding your benefit down the road, as opposed to just sharing the cost of your current coverage. So what that means is the police and fire, I think they all pay 3.25% or 3.5% all across the board. Town only, I know nurses pay, and maybe some other department heads or somebody else may contribute as well, employee contributions. But aside from that, no one else is doing it. There's only cost sharing as an active employee. Again, this could change going forward, right? As contracts get renewed, as towns want to start offsetting some of their costs, they may ask the retirees or the active participants to start kicking it a little more, right? You used to see that with the pension side, where employee contributions might have been 5%, and they trickled up to 6-7%, up to 10%. You can see some of those same things happening on the OPEB side to kind of alleviate some of those costs as well. Okay. So then the next block is the liability versus assets. So you can see unfunded liabilities, 37 million for the town, 55 for the police and fire. So you have 92. Again, that's a big chunk. We amortize this over 21 years. So that's where you see the discrepancy in how they develop of the ADEC. Again, police and fire have a little bit richer benefits, even though the population is roughly the same size. Their benefits cost a little more. So at the bottom line, or I guess there's 2 lines, because we do. And remember, an OPEB valuation is done every other year. So we developed an ADEC for 2 years. So we're developing the ADEC for the fiscal year ending 22 as well as 23. So here we see 4.1 million for the town, 5.5 million for the police and fire, for a net of 9.6 million total. and that's for fiscal year ending coming up 7/1/21 to 22, and that increases modestly up to 9.8 million for 23. Okay. So if there's any question on this, this is really the main, these are the real numbers that we're all waiting to see here. You know, all that other stuff I talked about was just kind of background noise, so to speak. This is really the bottom line. This is the number that I'm going to talk to the finance board and say, hey, this is ultimately what the contribution is coming up that you need to, budget for. I like it. Silence. I love that.
All right.
This board is doing great. I'm liking it so far. Just a couple more basic slides that we'll talk about. Assets. So this is just really a cash flow of the assets over the last 2 years. You know, they've gone from 42 million 2 years ago up to 52. So you've increased 52%. Again, bottom line, 3.6 and 4.1% over the 2 years. You really didn't do much on that side. You probably saw very similar on the pension side. You know, so hopefully this year is better. You know, so when we do it again 2 years from now, the funding ratio will improve. You know, things will get better. Hopefully that occurs. So you can see that there's no benefit payments coming out of the trust yet. You know, most plans, you know, they may set some kind of number where they want to be. You think about when you want to pay assets, you don't want to be paying benefits out of the trust where it's depleting the trust so much. You know, if you're paying 20%, you know, you're paying like 8 million in benefits. That's a big chunk. It's almost 20-25% of your funding value. So it would be hard for the assets to continue to grow if you keep depleting them constantly. So that's why most plans kind of let them build up to 40-50% funded ratio before they start drawing down. But again, that's entirely up to the town with the best policy, you know, works for best for them.
All right. This also, Stefan, this also should speak to our asset allocation strategy, that we're a little more, we're overweight equities in the OPEB in a way that we're not, you know, when compared to the pensions. We're not taking disbursements from the OPEB. We have a lower funded status. So, you know, this slide here really, I think, kind of cements the point as to why we have the allocation we do.
Yep. Okay. Anything else on that? All right. So as I mentioned, these are the benefit payments you're expecting to pay out. You know, so say your contribution's 9 million, and I did show that on the other page, but your expected benefit payments are 7.6. You know, and it built to 8 million. So that's a big chunk of your ADIC that you're paying, right? So when you pay out benefit payments, it's considered part of the, you know, when we do GASB, it is considered part of the contribution to the trust, even though it's kind of like it goes in and comes out right back out, right? So what you pay over this expected benefits is really how you start to build up the trust. So you can kind of see, you know, as you see these numbers grow, unless your unfunded percentage, you know, decreases, your ADIC gonna, you know, you're always about, this is really your minimal outlay each year, so to speak. Next, this slide here just kind of shows you data for the last valuation. Is that a question?
That's my blowing my nose.
Okay. Didn't mean to interrupt. Go ahead. It shows the data from last val to this val. Really, no change in the population. 1,100 people total. 1,100 this year, roughly. You know, 600 to 600. You know, so they really stayed roughly the same. So that's not a bad thing. And I think overall the ADIC might have gone down just a tad. You know, and that could have been just for some experience. You know, certainly the assets being that are funded, normal costs being roughly the same. It's really you did get a little bit. Your unfunded was probably a little higher in the 18 val. Now, you know, like I said, quick picked up to 36%. I think it might have been like 30% roughly in the last val. So it has gone up. So you've got some improvement. Very tiny, a little bit, but every little bit helps, right? You know, it's getting to the ultimate goal of being fully funded and having that trust work very similar to our pension. So this page, is, as Carolyn kind of hinted at, is how you're weighted. This may change going forward. Most likely it will, right? It shows you very heavily weighted equities, 42%, non-equities, 28%. So that's what's that almost? It's what, 50-70% in equities. So it's a 70-30 roughly.
Yep.
And even the real estate's 10%, which is not really a fixed. You know, you get kind of pretty good returns from that. So overall, you know, based on that, and you know, what we expect, what Vanguard provided for capital market assumptions, the rate of return, you know, it shows you right around the 7% roughly. You know, and this is based on their worksheet at the 50% so 50% is going to get this target, which is reasonable. A lot of, so that's why you see a lot of those give you a window where it'll cover 6.5 to 7.25 roughly. I don't like to go over what it states because that's kind of cherry picking and being best case scenario that you're going to actually earn more than 7% on a fund consistently. So 7% is being supported, and that's due to the weighting being heavily in equities for sure. So just kind of reinforces what Carolyn's mentioned earlier. And what is it? Oops, did I go over? Oh, so this two slides really for the Board of Ed, as I mentioned, because it's an unfunded plan. We don't develop an ADEC because it has no meaning for an unfunded plan, right? Because really all they do is do benefits as a pay-as-you-go basis. This just really the main number that they're gonna care about is $20 million number because that's what goes on their books and in GASB. And you can see non-certified, they pay 100%. So what happens here is they're paying 100%. Retirees pay 100% of the cost of the benefits, right? So you have no cost at all over 65, some under 65. And so really what they're valuing here is implicit rate subsidy. And what that is, even though you pay 100% of the benefit, the true cost of what those premiums are is not that, because there's the usage of age. You kind of have what we'll call an age curve or a claims curve. Someone that's younger, their cost of a premium is much lower than someone that's 60 years old. So say a 25-year-old their premium is maybe $2,000, where a 60-year-old premium could be like $4,500. So they're still paying the same rate. So you have under GASB, you have to kind of account for that difference. That's why you see the liability, even though it's 100% paid. And on the certified, another stipulation on the Connecticut statute is that retirees have to pay the same rate as actives, right? So even though it costs more for them, they're still paying the active rate. And another big driver, as you see these retirees over 65, that's over 10 million, which is half of the cost. Those are typically non-Medicare eligible retirees. So that means that their rate's even higher. So a Medicare rate may be, $400 a month. Theirs is probably $1,200 a month, right? Because they're non-Medicare eligible. So it's much higher. It tends to be, 5-6%, 6 times higher, the liability for those people. And again, they're still paying the active rate, even though it's way more expensive for them. But that's the rules under GASB that you have to follow. And last slide there is just, again, population for those groups. And their population didn't really change much either. So town's been kind of neutral there in that regards. And I show their payment. So they're roughly, you think about their costs, probably around $700,000 a year. That's their pay-as-you-go cost. And they get a little bit back from the teacher retirement subsidy. The teacher retirement board gives them a subsidy of $120 a month for a retiree. So they get that back. So that goes to offset some of their benefit, the payments. Okay. So recommendations? Continue. Not as many as in the pension side because not as much happens that you really can focus on. That rate of return based on how you change your asset allocation. We'll want to monitor that, right? If inflation continues to stay low, that may put some downward pressure to drop the rate a little bit. Again, we'll monitor those election percentages, right? Because that's a key component. You don't want to be overstating that, and you don't want to understate it, right? You really want to kind of get the best guess to what or from the data, what it tells you, who's actually electing that coverage. And again, we monitor based on what the collective bargaining agreements get settled on. If those change, we can see some, the patterns change of what people elect to be covered and not covered. You're going to still get the full people, the participants for the town to actually continue to coverage at 100% rate because again, free is free. Who doesn't take free? They're not going to not take that coverage, unless there's some plan that they can get better from their spouse. So you're going to continue to see that stay up at that 100% level or 95%. So that's the bulk of it. Any questions, comments?
Stephen, this is Brian at Vanguard. I had a quick question.
Sure.
When does it help you and the town to receive our capital market forecast for the year? I mean, we update them quarterly, but that snapshot as of what date?
This was the most recent that we were provided. I think this was like back in November of 20, maybe, the report I had. Typically,
Yeah, but the next time
what
will
we're
you
doing
do
the
it?
best rate. So on the OPEB side, you don't need it quite as frequently because this is going to be what's put in the CAFR, or going to be put in the GASB report that gets put in the CAFR, right? Because that's what these liabilities are based on. Unless something changes, where the town says, oh, we've changed something quite drastically, we may need to remeasure at a different discount rate, the long-term rate. But so we may still do that. You'll see some of those changes, those assumption changes on the GASB. But for your question, might be when we're doing the valuation. So obviously, OPEB not as frequently, but the pension right before. So after July, if that's going to, because we'll be working on the valuations in the fall, late fall, early,
Okay.
right around Christmas time. So that would help. And I've worked with a ton of investment firms, and not everybody gives it to. Some of them are like pulling teeth trying to get the information, even though it's required by GASB. So we have to kind of beg for it, and they give us information that we can't discern. You can't ferret out what we actually need, right? We need the real rate of return, right? So your inflation assumption, I think for these might have been 1.7%, if I recall, or somewhere lower than 2.4. And so, we always want to get that. We want to know what the underlying inflation assumption is, again, whether they're geometric or not, or arithmetic means.
Sure. No, thanks. Thank you for the timing.
Yep. Anyone else? I mesmerized you, I can see. All right. Turn it back over, or any comments? No question. It is what we don't have as much when we talk about the pension side of things, right? Because a lot of the assumptions that we used here have already been dictated to us by what we've decided on the pension side. Again, really the only difference is that, again, the trend and those utilization rates. Those are really the key differences in between the two types of plans. And just so you also are aware that on the Board of Ed, so for certified teachers and administrators, those assumptions are dictated by what the state uses in their pension plans. So we kind of mirror those as well. So we don't massage them any way differently. We're taking that's what they were deciding on. That's what we're going to use for this, because that's the same liability. That's how they're measuring their liabilities. All right, I guess I'll stop sharing. Turn it over to whoever.
No, thank you. Does anyone else have any questions? All right. I'm sure the conversation will be far more spirited on the Board of Finance side of the.
Tomorrow night. So I'm gonna get a lot more questions tomorrow than I did tonight.
Yes.
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 Fortunately.
I didn't even know about that meeting until a few days ago. I was like, oh, after Wednesday night, I'm good. I just have to produce the reports. We're all good to go. Oh, no such luck. All right. The matter of which, I think they're going to focus more on the pension side, I would typically think. OPEB always tends to be a little more in the gray area for most municipalities, harder to understand. Benefits aren't as cut and dry. One of the things I like to point out is, these benefits tend to be more volatile than pension. Pension, you kind of know what they're going to be. You've promised that, a 2.5% multiplier times years of service. So you kind of know what's going to change those benefits is salary, right? Really just salary is going to change that. That's how your benefits can go up and down. These, you don't know. Medical, no one knows what medical is going to do 5-10 years from now, right? It's so crazy. From year to year, you can have premiums jump 15-20% in a year. And we've seen that in the past 5-10 years. You've got the last couple of years, you've had favorable experience, so it hasn't happened, but it doesn't mean it won't happen again. We don't know what's going to how they're going to set premiums on this. One person asked me a week ago, there was a lot less utilization, right? Not many people, there was a lot less claims last year. It's not as many people are going to the doctors as frequently as they were. A lot of those elective surgeries didn't happen. Is that going to change the premiums or not? I don't know. I'm not a health expert. I don't know how they're going to do that, how they're going to handle that. But you could see long-term effects, right? Because they don't know yet the full effect of what happened with COVID for people who've got it, how it affects their medical health down the road. We don't know. Could be a lot of mental health issues that start popping up right after people being in quarantine for so long. So we don't know what's going to happen, I think, with those. So it's just kind of keeping back your mind why the medical benefits are much more volatile than on the pension side, a little less predictable.
Well, good luck tomorrow night. Thank you for coming and presenting this to us on kind of the new timetable. I think this is a lot more beneficial for the town.
Yeah, and the timing is really dictated when we can get the information. You know, I would have been happy to give it to you last month, but we didn't have all the data. And I think part of that was just there was so much going on the town side last fall, as you recall. You know, they were talking to Europe. They had a lot of things going on. It just, you know, was one of the things that kind of gets put to the side. You know, and we also have to gather data from a lot more sources than we do on just the pension side. Pension, we just call a town. They give us the salary data, the participant data. You know, here we got to get premium data from the different medical carriers. So we got to get involved with them and all. And so there's a lot more moving parts and pieces to get.
Well, thanks again. Thanks for coming. If there are no further questions, guys, I'm going to move on to the next item, and we're just going to keep rolling through.
Thanks,
Thank you.
Dennison.
All right, we'll talk to you later. Have a good
All
night.
right. So, guys, I wanted to bring us back. The next item on our agenda is to hear, consider, and vote on the IPS review changes. And I'm going to share my screen here. Make sure I got the right one up. Here we go. So I sent you again the December approved, the December 2019 IPS. And what we had there, if you recall, we had two items that we're here to talk about that we spoke about last month. One being the actual allocation of the assets, and the other one being the language for the proxies. And I'm going to kind of hit the proxy one first, if you don't mind, and open that up to conversation, and then we'll talk about the asset allocations. So in the proxy language, if you remember, I proposed putting in language that calls out encouraging consideration of environmental, social, and governance issues, which are called ESG issues, to the proxy voting for our co-fiduciary and OCIO Vanguard, feeling that that's consistent with our board's fiduciary duties as a long-term investor. So what we did is you asked us to kind of go back and have Vanguard kind of take a look at the language and how they feel about it, and then ask our town attorney to take a look and help us understand how they feel about it. And the language in here reflects, the new language in here reflects both of their respective inputs. So it's in red on the first half of the screen. So I'll read it out loud, the whole paragraph. Vote, proposed language, right? The part that was already here: voting of proxy ballots shall be for the exclusive benefit of the participants and beneficiaries of the funds. Therefore, the investment managers shall review each proxy ballot and vote them in a manner that preserves and enhances long-term shareholder value. And then in red is the new proposed language I'd like us to consider. It says now, this may include consideration of environmental, social, and governance issues, parentheses, ESG, which are consistent with the board's fiduciary duties as a long-term investor. And the changes here are to soften the language, insert the word may in place of shall, and then at the very end to add as a long-term investor, so to describe why this is part of the fiduciary duties of our board. So that's the proposed language. I'd love to get your thoughts on that. And perhaps easiest way to do this, why don't we, hey, Tom, can I ask just kind of a question here procedurally? Do we do all of this in one motion? Is that easier, or would it be easier to split these into two?
I think it'd be easier to split them into two.
Okay. Okay, so I'd like to make a motion, just so we can set this up for the discussion. I'd like to make a motion to incorporate the new language that includes, under the proxy session, which includes the sentence, this may include consideration of environmental, social, and governance issues, ESG, which are consistent with the board's fiduciary duties as a long-term investor. May I ask someone to second that motion?
I'll second it, Eric.
Okay, thank you. Why don't we open it to discussion? Let me kick off the thinking around it and then open it to everyone. So if you're not kind of current on what's happening with SEC and regulation, there were very few updates to regulations and SEC between 2008 and 2015. But from 2015 on, there's been a lot of activity regarding proxy voting, regarding ESG, regarding long-term investors and what our responsibilities are. And I think you will find that it is seen as absolutely hand in glove that long-term investors are concerned about the primary values relating to generally environmental, social, and governance issues. That they make for better managed companies, which make for better long-term investments. And so it is within that spirit that I'm kind of proposing this language. In addition, I think it's really important to bring out that when we moved to our OCIO model with Vanguard as a co-fiduciary, we effectively moved most of our assets over to being managed in a passive way and away from being actively managed. If you disagree with the management of a company or the board of a company in an actively managed portfolio, you have the ability as the portfolio manager to sell that company out of your portfolio, right? You can sell. In the case of passive investing, we broadly own the market, right? We don't have the luxury of being able to sell something and move away from something we don't agree with. And so I think it's no surprise that since 2015, you've seen these considerations for ESG become more important as a way for managers, our investment managers, to kind of help guide better behavior, if you will. If I can't sell the security, I can certainly guide the behavior or vote within the proxy that I disagree with what the company is doing. And it's become a really important tool in investment management. So my thinking, my hope here is that we will adopt this language as a means that kind of recognizes where we've moved over to passive investments, that this is the way for us to kind of long-term align our investment values. And this is a way for us to kind of state to the town that we are aligned with our long-term values. Vanguard, and then I'll turn this over. Vanguard, you'll see in the presentation, if you haven't taken a peek at it yet, included a lot of pages on their stewardship. So they're doing this already. This is the town's document. And I think it's, Vanguard's doing this. We've incorporated their language. But I do think this makes sense for the town. So why don't I see if I can figure out how to unshare my screen and we can have a conversation about it. Anyone else?
Well, I say, Carol, I was one that kind of was concerned with the strong language of the shall. I mean, that was my biggest concern because I didn't think we could, guarantee in every vote and every, that we would align. So I'm very pleased with the word may, and I like that the long term. I think it's perfect. I'm very comfortable with that new language. That's it.
All right, that's good.
I think it's good.
I agree with that, Carolyn. I think the way the language was softened addresses the concerns that were raised last month. So I'm fine with it.
All right, we see nodding of heads.
Caroline, I'm just going to throw this out because I do agree to May, and I thoroughly, I mean, the first part of it, I certainly agree with, that we align ourselves with our fiduciary responsibilities based on, let me just bring this up again.
Here, I can do that. Do you want me to bring that?
I got it.
Okay.
Shall be for the exclusive benefit participants of beneficiaries of the funds. So one of the things I kind of, the first thing I kind of thought about is to what extent, I mean, we're kind of setting direction, as goes the captain, so goes the ship. And if we're influencing who the captain is. To what extent do we influence making or economic decisions which are to some extent political? I think of things like ethanol, where there's no economic reason to have ethanol and it just drives up food prices. But for the sake of what appears to be making a step towards renewables, we do it. But for the sake of economics, it wouldn't stand on its own. So I'm just wondering to what extent we do things now which distort market, normal market forces.
Yeah, I don't know if Brian's still with us. I don't see him here. I'm sure he'll pop back. So remember that, so firstly, these are not exclusionary, right? We don't have any exclusionary funds. So it's not like we would exclude big oil in favor of renewables. And by doing so, while it might be the right thing to do, to society, it might be not the right thing to do from a portfolio investment return framework.
That's exactly the point, where to some extent I'm trying to reconcile those two thoughts.
Yeah, and that's not where these funds are invested. Right. These funds are invested broadly across the markets. Right. I mean, Brian's rejoined us. Yes. They're passive ETFs and index funds. We own everything. And even Vanguard, I believe, it doesn't take an exclusionary approach to this. Brian, Tom's question was, I don't know if you heard the whole question.
Yeah, no, I did. Yeah, I was here. Maybe my screen was hidden. I had probably only so many faces that could pop up. But maybe one way to think of it, Tom, is one is how you vote the proxies. The other one is how you manage the investments. And so this was language about voting the proxies as a shareholder. And Carolyn is right. Like we don't have any direct or specific mandated ESG funds in the portfolio. In this case, we have the total stock market index or the total international stock index, and there's no ESG lens on that. It's just owning the whole market. Some organizations, and it started with endowments and foundations, it's certainly spreading, but whereas they will say we don't want to hold, or religious organizations, we don't want to hold these type of stocks. So they don't own the total market. They own the total market X, the sin stocks, right? Alcohol, tobacco, things along those lines. We have not put any exclusionary criteria on any of the funds that are managed here.
Right, and I thoroughly understand your point. There's no direct correlation here. I get that. This does not. I mean, this language does not directly influence funds, but kind of long term, there is an indirect influence, if you will, and even that, to some extent, when you start to ignore economics and do things for political reasons, I don't know that it necessarily helps the investor, and that in that respect, I see some degree of conflict between the first part of the language and the second part. I mean, I'm encouraged by it said, took the shall out and put may in. But I mean, the reason I bring this up is Carolyn and maybe Eric can just help me feel better about this, because right now, I mean, I'm not agonizing over this, but I bring it up because I think we have to discuss it going with our eyes open to what this really means.
Yeah, and there are a lot of ways to get at that, Tom. There have been a large number of empirical studies, and maybe Vanguard can point to some of them, that show that companies that are well managed and managed for the long term and kind of you manage along the ways that are, that are in keeping with long-term values, which are incorporated in the ESG thinking, outperform companies that don't. And there are also considerations that, for instance, if we'll take an example, corporate boards of directors, that diversity of thought is as important as diversity on gender or ethnicity or experiences when thinking about the governance of a company. Or pay packages that are more in keeping with considerations. We can have conversations about runaway corporate pay packages in light of the fact that companies may have been kind of supplier of opioids, for instance. Right? I mean, however it works out, that there is a growing empirical body of evidence that shows that companies that are managed if in keeping of these types of long-term values ultimately are better long-term performers. But you're right. I mean, this is kind of a statement of values. It's becoming more empirical, less straight political, particularly on the governance side. But maybe Eric can speak to it in greater detail than I can.
Example is on NASDAQ. If you go listen on NASDAQ, you now have to have a diversified board of directors to get listed there now. So every company every private equity company that potentially might end up on a NASDAQ now has to have that. This is just giving more at the highest level, we're just a piece of a much larger industry, right? Is what, $9 trillion of public pension fund money that's getting behind this, right? It's not all there yet. We're just, over time, more and more it's going to go there. It's making a statement, says we're supporting the managers, we're supporting the underlying, everybody down there. This is important. And when you look at investing in portfolio companies, are they doing the right thing? Are they reducing risk? Risk is, not having, diversified boards, right? Because you're going to miss something. It's just good governance. You look around the world and you look at places that, companies that trip up, there's probably a governance issue. And if they happen to look at things differently, somebody on that board or several people on the board, everybody comes from a different point of view. So I think that's good. It just creates a better pipeline infrastructure of the industry to gain behind it. There's tremendous amount of research out there that, recently one of the surveys came out, said that, as a survey of LP, 62% said, the ESG and transparency is important, and it's increasing. And we could either, be at the forefront and move forward, or we're going to be at the end. And, it's another thing that's going to become more of an issue of which funds don't have it, which do. And you don't want to be on the list that says, oh, we were too slow to move something along. So I think I'm for it.
Brian,
We're
can you
not-
speak
we're
to
not-
what
we're not dictating-
empirical data there is to say that diversified boards outperform other boards?
I can point to some research that it would say, or the research would say it's inconclusive. And what I mean by that is there are studies that say yes, and there's studies that say no. So this is opening a whole different topic, but it's, you really have to know what or how, if we're not talking about voting proxies now, I'm talking about managing investments, is how the manager does it. And I'll say it in this framework. The E or the S or the G can mean different things to different managers. And I'm not even talking about Vanguard. And so I think it's all how you define it. And therefore, so some of the studies will say yes, and they define it this way, and others define it a different way. It's inconclusive. I will point you to a journal article that Vanguard has contributed to on this research. It's separate from the materials I sent last month, which is talking about, or the slides I included in here today. This is talking about our investment stewardship as an index fund manager who needs to vote proxies on behalf of our investors. And the E, S, and G is part of a principle that we call or define of oversight of strategy and risk. And so we think a board of directors for a public company needs to have a good understanding of the risk of their strategy, and that certainly could include environmental, social, and governance issues. And so I think that was part of the reasoning of including the word may instead of shall. It's less definitive. And two, the other point was, right now the portfolio has moved and the public equities and fixed income are all passively managed. But what if we decide to introduce an active manager down the road, which we certainly can? That active manager might vote proxies differently than Vanguard. So I think that softening of the language to the may allows that you're not changing the IPS language every year. The IPS should be reviewed every year, but maybe you don't want to be changing it. So I think the softer language allows for the incorporation. And then just speaking from the Vanguard side, as the index manager, we incorporate those factors when how we vote the proxy. But it's ESG is, there's so much being written on this space, and of course now the government is involved in defining kind of rules. Should you, or meaning investors, consider ESG or not, in selecting funds.
Brian, you don't have to sell me a diversity of thought. I get that. I work for a Fortune 100 company that's our CFO's from India, and our past CFO's a lady. So I get that element of it. My only point is, and again, as you say, there's no direct correlation, but I think this, my only concern is you doing things that, don't make good sense economic. That's my only concern for the, diversity of thought is, I thoroughly agree with that, because if you overlook that, you end up going down the wrong road. I think that many companies have done that.
Jared, did you want to speak?
Yeah. I just want, Tom, I had the same concerns as you did, with decisions being made for political reasons. I'm very, very concerned about that. And, any of those decisions that the investment company may make could, the decisions and the underlying issues could run across a spectrum of being, very political to not political at all. And so the way I look at this is that by including the may in there, allows Vanguard to look at how political is it, and to be able to see that this is a very political issue, and so we're not gonna vote in favor of that, or because it is political, and at the risk or to the detriment of the investment or the economic, the economics of it that you mentioned. So, that's the way I look at it, it still gives Vanguard the ability to cut through what is political and what makes good economic sense. That, in short, that's the way I look at it.
I
Brian?
don't disagree. That's a good point. I mean, again, but we do stupid things in this country, like we move things with trucks instead of train. It's much easier to move things by rail, but the only thing we move by rail these days are bulky items like coal and lumber. It's much more efficient to move things by rail than truck. But why do we do it? It's a heavy influence, and what we end up doing is it distorts supply and demand curves. It just distorts market values of things. So again, it's those are things in the back of my mind when I see things like this. But Jared, you make a point. It's by virtue of the fact you put may in there, what it does more than anything is just kind of our stake in the ground. This is where we're coming from, and we think that's that there's value to be had by ESG, and as long as those decisions don't supersede or eclipse
Mhm.
what otherwise would be, sound economic and financial decisions.
I think, Tom, if I can respond to that, if we just kind of read the paragraph again, right? I mean, the first, therefore, the investment managers shall review each proxy ballot and vote them in a manner that preserves and enhances long-term shareholder value. So the returns come first, right? That's the shall. And then this may include consideration of environmental, social, governance, ESG, which are consistent with the board's fiduciary duties as a long-term investor. So in my mind, the return profile has to come first. And then it's more of a statement of encouragement that where you can.
Right. And that does make me feel better, Carolyn. The one's primary, the other one's tertiary. As long as we understand that, I think I'm good.
Hey, Carolyn, it's Jack. I mean, we can encourage Vanguard all we want. At the end of the day, this is a town document, and Vanguard's going to vote how they're going to vote. I mean, we really don't have a whole lot of say in this.
Right.
Exactly.
Right. But it is, it is the town document.
Right.
Right. Kevin, you've been really quiet. Do you have any thoughts on this? Oh, I think you're maybe muted. Is he still muted?
Yep.
Still muted.
Just go like this.
Is that any better?
Yes.
Yeah.
No, I agree with both sides of the argument, and I don't see a lot of exposure. I'm just trying to be quiet. I got something else going on in my private life that I'm working through, so it's not intentional.
No worries. Thanks. All right. Nick, you're here. Any thoughts?
I'm here. We don't even have a universe of people who can unanimously decide on the definition of these terms. However, we're looking at Vanguard, and they have a fiduciary responsibility to us and shareholders alike. And they're trying to do the right thing for all of their customers. And by inserting what Carolyn has suggested, covers us from both sides of the table, I think. And you can discuss this till the cows come home. And there's small elements that, you can be on one side or the other. But I think when you look at the situation, what we're trying to do is more than satisfactory for our concerns and for anybody else's concerns. I think it's kind of a moot point, but our intentions are correct. And I think the insertion of the language is about as acceptable as one can have. That's my comment.
Thank you. All right. Anyone else? Scott, Chris?
As I said, I'm fine with the language. I think it's consistent with the existing language in the IPS. So I'm in favor of it.
All right. Then that being that, I see Kevin stepped away for a second, but can we call it to a vote? Okay. All in favor of updating the IPS voting of proxy section to incorporate the proposed changes that adds the sentence. This may include consideration of environmental, social, and governance issues, ESG, which are consistent with the board's fiduciary duties as a long-term investor. Although looking to vote aye, please raise your hand and say aye.
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 All right, that looks unanimous. Any opposed? None. Any abstained? None. Motion passes. Thank you, guys. All right. Let's move on to the next part. Thanks to our wise counsel in separating these into two. This is the asset allocation, and this part I will, let me see, share my screen. Okay, guys, what you're gonna see is the corrected one that doesn't have the math typo in it any longer. So here we go. So we talked all through this. This is more just to show you, and we'll open it up for conversation. It's up here on the pension assets. We tighten the minimum to maximum band to 10% from where it was at 20 percentage points. So total equity minimum is 50%, maximum 60%, targets 55. And likewise down the line, we consolidate the emerging markets category into the non-US equity category. We've eliminated from this recording the categories hedge funds, multi-asset, and commodities because we're no longer invested in those categories and those assets. And effectively going forward, we would consolidate those allocations into domestic equity. And then we reduce the cash target to 0% because as we went through last month in the meeting with Vanguard, we're invested in such liquid assets that we're quite comfortable that we can serve our cash needs without having a separate category for cash. On OPEB, down here, we're doing a similar thing, but we have a higher weight to equities. We tightened the minimum maximum band to 10% from 20 percentage points. We're breaking global fixed income out into US and non-US fixed income. And we're adding a cash category. And as you can see, that same strategy, likely minimum of 0% cash to 2% on the maximum side for the same reasons. Okay, I'm gonna.
You muted, Carolyn.
Unmute me. Okay. So why don't I ask, why don't we make a motion to, all right, could somebody make a motion? We'll put that on the table. Jared, make the motion to approve this IPS allocation.
I'll second that.
Second from Tom McCarthy. Okay. Can open to any discussion or comment, guys?
I was good with last month.
Just better without the typo.
Yeah.
It hasn't changed, just corrected the typo. All right. And in that case, we're not a chatty group on this. I will ask for a vote. All in favor of this as proposed, the IPS as proposed, raise your hand, say aye.
Aye.
That's everybody here. Any opposed? Any abstain? All right, we have passed. All right, you guys, thank you. All right, with that, we move on to the performance review. Brian, that's all you. Here.
Okay, good. Give me a moment to pull up the presentation. I'll share it on the screen. Let me close some. It looks like I may have too many things open. Let me know. Does it come up on your end?
Got it.
Okay. Oh, good. So just to set the expectations, we'll do a review of the performance of both the plans. I did include on this topic some slides about the investment stewardship efforts at Vanguard. This is in addition to the 2 papers I sent after last board meeting. Those were probably over 30 pages each. So I know you may not have gotten to all of them, but nevertheless, I wanted you to have them. And then 2, just I'll hit some of those main points on the stewardship topic. And then I do have some outlook which I could speak to. What I always welcome is your questions as we go along. So please always interject. Recapping, I'm on page 4 here, where we are on a year-to-date basis through the end of February. In sum, the stock markets have continued to climb. So with respect to the US markets, up 2.9% at the end of February, even higher as we are into March. Non-US stocks simply also up, just still a little bit trailing US stocks, but positive nonetheless. The bigger action, or what's erased some of the gains for investors, is on the fixed income market. And here you'll see US bonds and non-US bonds on a year-to-date basis are both down 2.3%. That all really is a function of interest rates. So in inverse relationship, as interest rates go up, bond prices typically go down. So with the additional stimulus that the government has passed, as well as better news around vaccines, certainly higher expectations for economic growth here in 2021, and therefore on the longer end of the curve, let me flip forward, and I'll go backwards. You see the yield curve. This is the dark blue line. At the very short end of the curve, that's controlled by the Fed. They're still holding rates close to zero, and they've indicated that that would be really as of right now, their expectation is no Fed hikes until 2023. However, the long end of the curve, like the 10-year and out, is set by the market. And so as expectations for further growth, and therefore maybe some expectations around inflation, we've seen the longer part of the curve, or all parts past a year, increase. So coming back, that's what's driven negative returns for fixed income so far this year. I included slide 5. As you may be aware at this point, we own, so for instance, the total stock market index, so it includes large, mid, and small. And I only include in this because market leadership changes so quickly. It was prior to November, small caps were lagging large caps by a large degree. We've seen small caps since November really accelerate as the hopes for the economic recovery continue. Same thing with value and growth. We own the whole market, but growth has been such an outperformer over the last year. And more recently, the last 3 months, you finally see some value stocks moving. But we feel like that's the benefit of owning the market and not trying to tactically decide what's going to happen. Talked a little bit about the fixed income market, so I'm going to skip slide 6. That just dissects the different segments. Longer term government bonds did worse, but we're not holding any term long government bonds. That tends to be held by corporate pension plans. And slide 8 relates to my comments. I included this one. I haven't included it before. It just talks about market leadership. Again, it changes rapidly, but even on a year-to-year basis, it changes. And I'm really focusing on the black dots, which is the path that we're really following is a balanced approach. And it may not be at the top of any given year, but it also won't be at the bottom. So just embracing a well-diversified portfolio, which we certainly have here with the town's 2 plans. So page 9 is looking at the actual performance on a 3-month basis. We don't have the year-to-date. I mean, we don't have the calendar year-to-date. We have the fiscal year-to-date. But on a 3-month basis, yeah, still, like I said, climbing up over 4%, slightly above its benchmark. Really, that's just some tracking error. On a fiscal year-to-date, maybe this ties more into with the OPEB discussion earlier, or Hooker and Holcomb's presentation. Fiscal year-to-date, very strong returns, up over 15%. It'd be nice if we can hold on to that through June. The relative underperformance, so I'll get to in just a moment, really that's coming from, at this point, from a fiscal year-to-date perspective, really just coming from the alternatives, namely the private equity, and that's on a lagged basis. I'll show you that in just a moment. As far as what we monitor for the plan is, here are our policy targets. Carolyn talked about those being memorialized in the IPS as well, and where we are versus those policy targets. We keep a tight range. We use cash flows to rebalance each month to those targets. So for instance, and Jared will hit on this later, at the end of every month, we're raising cash. You see it was 3.3 million. That tends to be temporary. We pay benefits in the beginning of the month. We just raised some cash today for the April payments. But again, this is, very minimal amount. I'm flipping to page 10, and this I'm just highlighting on the private equity side. These are on quarterly lags, so we won't have the December numbers until, maybe very soon. But what I'm pointing out here is, the private equity returns is showing of 19% versus the Russell 3000 benchmark plus 3% of 34. That just has to do with how quickly the equity markets have recovered from last year. So I wouldn't be surprised for the private equity gains to catch up as we, get past some of the lags. Really no concerns there. I just wanted to point that out in context of the fiscal year-to-date number. If you look at over 1, 3, 5, 10 years, your private equity investments have been additive to the plan. I'm going to skip through and just bring you to the OPEB plan. And here the results have been.
Brian, before we do that, if you could just hop back one screen. So on the pension, you're comfortable and good with where the allocation is right now. You wouldn't reposition the portfolio at all.
Overall, the strategic targets?
Yep. I mean, within the min-max, you wouldn't move anything around, or?
No, Carolyn, we don't take that stance of what's going to work in the short term. So we don't have any plans to move those allocations away from the policy targets, and the movement plus or minus versus the policy targets really has to do with market movements. So we don't have any tactical views within those bands.
Okay.
It wouldn't expect, you shouldn't expect that from Vanguard to be moving it around in the short term.
I didn't think so, but I figured I'd ask anyway.
Yes, and I mean, at least on an annual basis, I think it makes sense for us to revisit the asset allocation and, in light of what the long-term objectives are. But from year to year, you won't see us actively shifting the portfolio within those targets. Page 12 is the OPEB, and here the results are stronger, both on a 3-month and a fiscal year to date. So 3-month up over 5%. Again, comparing, so you don't have to flip back, is 4.38 for the pension. Fiscal year to date, incredible to see a 20.5% return. Again, this is all reflective of the more aggressive asset allocation, 70% equities, 30% combination of fixed income and real estate, as articulated at the bottom of page 12. One thing that we're keeping an eye on with respect to that rebalancing is, we set those plus or minus 5% at the total asset class level. So if you look at U.S. equities and non-U.S. equities, 3.8% over. It's a little bit higher if I looked at last night's close. So if we breach that, we'll certainly notify the committee, and then work with Jared or Caitlin to do any rebalancing if that happens. I only say that in the context of the OPEB plan because it doesn't have the amount of cash flows that the pension plan does. Pension plan is paying out benefits monthly, but we also have capital calls and distributions from our private equity investments, which are not found here in the OPEB plan.
Right. Right. That's a good problem to have, Brian.
Yes. Yeah. Stay the course. So with that, as an update, I was going to turn over to the investment stewardship section, and I think it was Nick that covered it, but everyone did. I think everyone recognized this, and this is what Vanguard believes. good governance matters. And so we are looking to promote and protect long-term shareholder value. That's our main focus. And I think Carolyn articulated it really well. Why is that? Because as an index fund, really we're holding these securities in perpetuity, right? Not like an active manager who can just sell it if they don't like it. So if anything, we're incentivized even more to make sure that there's good governance at these companies so there's better long-term shareholder return. So what drives how we think about investment stewardship? It's these 4 principles that are on the page. And this is the lens that we look through when we're considering how we'll vote a proxy or a shareholder proposal. We're considering the board composition. We want boards to be independent. We want them to be capable and experienced. That sounds logical. And we also want them to be diverse. And diversity goes beyond just a gender and a race. It's diversity of experience, skill, and it could even be, certainly be age, right? We can benefit from all of those. So those are the lens that we look at from a board composition perspective. As far as oversight of strategy and risk, we're thinking, we believe that directors should be very knowledgeable about the risks that the strategy that the company is looking to execute. And within that strategy and risk, certainly this is where you find some of the environmental, social, and governance issues that would really fall within this principle of strategy or risk. Because if I'm just making a broad statement, if an oil company was maybe not thinking that there could be long-term implications of climate change, well, then that's a risk to their strategy of maybe diversifying beyond just fossil fuels. So that's one context of what we look at it. The third is executive compensation. We are looking for, and we think that the management should be incentivized to outperform versus their peers, but importantly over the long term, not taking undue risk in the short term. And then the fourth is shareholder rights. We certainly believe in shareholder rights, and that at the individual level, and that we look for appropriate governance for all these companies, and looking for the structures to protect the rights of shareholders. Some companies have different class of shares, whereas allows founders maybe to hold more voting rights. That would be something where it would give us pause or concern with the governance of a company. Very quick overview on page 19 of our team. We have 35 members that are dedicated just to this investment stewardship effort. It started out all here in Valley Forge, Pennsylvania. We've certainly expanded this team into London. And I know that we're in the process of having some more folks in the Asia region. So this has been a growing team, and I'll show you a little bit more of that in a moment. So what does this team of 35 individuals do? Well, we look to be public advocates, for these principles. We look to engage with the companies. This is not only with the CEO or CFO, but it's also with holding meetings with the board of directors for every public company. And then the third, which we've been talking about certainly here tonight, is proxy voting. So these are the three things that the investment stewardship team of Vanguard is tasked with: being a public advocate, engaging with our companies, and then voting the proxies on behalf of our shareholders. This is page 21. I only included this. I'm not going to speak to each one of these boxes, but I just wanted you to see all the different organizations that Vanguard is a member of. That informs a lot of our research. And we like, Vanguard takes pride in being grounded in research, driving our decisions. And so we think it's important to be a member of a lot of these different institutions to get insights that form our views. Page 22 included, because just so you know, we have a wealth of material on on this topic. I shared 2 of the papers with you after the last board meeting. I'll continue to do so as we release something, or at least on an annual basis, make sure you have our annual report. We publish an annual and a semi-annual report, so I'll make sure that the committee sees those. And if you're interested, I even included down below there is a specific domain, within Vanguard for our investment stewardship website. If you wanted to learn more about it. So I will continue to share the research that Vanguard publishes with the retirement board.
Thank you.
And then lastly, this kind of brings the history of it. Was there a question? Okay. Page 23 is, this has grown in importance recently, but I wanted to provide this as context that, Vanguard's been doing this all the way back to 2001. So while it's more in the press more and more, that staff was only 2 people in 21. Now I told you it's over 35 people. But this has been an important aspect of how we think about shareholder rights and voting for, you could see, about 20 years now. So I wanted to give you a timeline of some of those important milestones of Vanguard's history in this. Went through some of those at a high level, as there's certainly a wealth of information. I'll just pause for any questions on this topic.
I'm happy to see it, right? And
Yeah.
it is accelerating, as your timeline here shows us.
It is. As again, part of it is a factor of, how large we've grown as an investor. We take that responsibility seriously, and so as a result, as of the Vanguard assets have grown, to over $6 trillion, that makes us and has more impact when we're voting shares. We might hold 5% of a company, given the growth and indexing that Vanguard has seen, but others as well. And so it's taken on more importance. It's always been important, but I think it's just been highlighted. And then I'll wrap up on page 25. Just our views. We update our market and economic outlook each month, though it doesn't change dramatically from month to month. Just to give you a couple points on, I think the big things that are out there about interest rates and inflation. May have talked about some of this in the past, but 2 things. One is, as far as inflation, we haven't printed over 2% yet, but we expect to see inflation number over 2% here in 2021. However, we think that's a result of coming off of a very low base from very low inflation numbers last year due to the pandemic. But we don't see any type of runaway inflation. I think that's pretty consistent with the Fed views. Taking that out is, as it relates to interest rates. So the Fed is willing to tolerate, and I think they're also expecting interest rate to drift over 2% for a little bit. And they're comfortable with that. They wouldn't raise rates right away. But the Fed is also continues to say, they don't see a rate hike until 2023. Their dual mandate is inflation, also in full employment. And so there is still slack in the economy from an employment perspective. We're still over 6% unemployment. But beyond that headline numbers, the labor force participation rate has also dropped as people have had to exit the workforce either because they can't find work or parents having to leave the workforce to take care of kids with school. So the labor force participation rate has dropped, and we need to see that come up as well. So therefore, we think this recovery is, while we expect it to be strong, partly due to the big stimulus that the government has passed, but the full recovery will still take a couple more years. So longer term, we still think inflation will remain muted, and therefore we don't expect big rate hikes, in the foreseeable future either. We think that the 10-year right now is about 1.6%. We think that, if that were to rise much further, maybe the Fed would get concerned, but there's other tools that the Fed has to bring rates down in the longer end. They could start buying some longer dated maturities. It's something that's referred to as Operation Twist. You know, the Fed's done that in the past. So I think the Fed wants to keep conditions accommodative. And if that 10-year were to rise much closer to 2%, maybe they would take different action.
Okay. All right, so we hold the course.
Hold the course, stay the course, stay the course.
Anyone have any questions or any thoughts?
Nope.
All right, Brian, thank you very much.
Always my pleasure.
Thanks for all you're doing for us. With that, let's pop it over. Jared, you are up. CFO report, please.
All right. I'm going to be quick. Just talk about some of the activities. I don't know if everybody has the report. I sent it out late. I can share my screen so you can see it. There's not a ton to see here, but I will share it and talk briefly. So rest assured, payments were made to the pensioners last month on time, and you can see the amounts there. $1,073,948 for the fire and police, and for town employees was $1,108,478. As Brian mentioned earlier, the transfer was made today to be able to make sure that we can cover the payments that will go out at the beginning of April. And you can see the amounts there at the bottom for that were transferred today on 3/24. I could segue pretty easily from here to talk about pension payments if you'd like.
Let's do it.
Okay, so as we talked about last month and have been talking about, People's Bank got out of the business of issuing pension payments to the pensioners. So we have inked a contract, which I sent around to all of you earlier this month, signed by me, Carolyn, and Brenda, just to let you know that we had, to reassure you that there's not going to be any kind of lapse or anything, and that they'll continue to get their payments. And so pen checks will begin, if everything is on course, will begin sending out their and doing their job for the first time on May 1st. And again, that's going to be a temporary situation until we can have a deeper conversation about who might do that and other services in the future, and we'll have some presentations on that, and this make a more permanent move once we think, once everybody's satisfied with information we have done RFPs and done our due diligence. So
yeah, thank you for hustling on that. Here, you can unshare your screen. Thank you for hustling on that. I'm really grateful that everybody will have a seamless transition. Our pensioners will receive their checks on time, right? That we will not have been caught flat-footed through this. And we'll fire up another RFP. Shortly.
I have a question real quick. Jared, I mean, is there any penalty or what would happen if the checks were ever late or not on time? Has that ever happened? And what would be is there any recourse or penalty, or I'm just curious, sorry.
Any penalty on us?
On us, on the town?
I don't know the answer to that, and whether or not there's something like that covered in a contract. I'd have to look into that. Yeah, it's a good question. I'll make a note and I'll look into that. We again, we don't anticipate anything like that happening, but worth looking into.
We are obligated to it per the town code and the charter under our responsibility as the JREP. Yeah, there is very specific language that obliges us to make sure that they get those checks on the first of the month. So would be good to know.
Sharon, I think that's your responsibility, so I think your name's at the top of the list.
Yeah, we're gonna make sure those people get their checks, let me tell you.
You know, I'll say too, I think we, although we haven't talked to them about this, People's Bank has said that they would be flexible. And so if there were some kind of snafu between us and Penn Checks, I would expect that People's could continue to do it for another month, if worse came to worse.
Right. Thank you. Anything else, Jared?
No, not unless there's other questions.
No. On all, the only other thing I'd like to say is, the subcommittee that we formed to evaluate the RFPs regarding our actuarial services, is dutifully doing their homework, and will likely convene, and share their thoughts over the next couple of weeks. Timing on that, targeting to have kind of a short list of potential candidates come to present to this board during April. No, not April, May. May is the month that we're targeting to have some come in for the full board consideration. Okay, and I can tell you those RFPs are thick and not exactly the most riveting body to read through. Not super exciting. But very informative and very useful. So we're making our way through it. That's all I have. Does anyone have anything else under our new business? All right. You guys, I really appreciate all you're doing. Thanks for being here. WebEx makes things very efficient, doesn't make it very warm and friendly. I miss the in-person meetings a lot. But I'm very grateful to all of you for coming here and plodding through. So
Thank you.
yeah. Can I ask for a motion to adjourn?
Thanks, Carolyn.
Tom, you
Motion to
ready?
adjourn.
All right, second that. All in favor? We're out of here.
Aye. Have a great night.
Bye, guys.
See you
Better
guys.
way
Have a good night.
metaphorically.
Bye-bye. Good night.
Bye-bye.